The momentum is the topic of today's webinar. I'm going to start first. I'm going to kick it off, and then Toronto is going to complete the second part of this webinar later on. Before we take a look at this topic, one thing though on the disclaimer side is the fact that this webinar is intended for a global audience and may not be suitable for all viewers. To find out if it is and other details, please visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. You can also use that same website to ask a copy of this risk disclaimer. It states that trading for exchange is considered high risk and it may not be suitable for all traders and investors. Please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for educational and informational purposes only. And by continuing watching this webinar, you agree with the risk disclaimer. Good. Thank you for your attention. Once again, welcome. This is hosted by Admiral Markets. And well, before we actually take a look at this slide, of course, I mean, it's difficult to avoid a bit of introduction on a discussion on what happened with the ECB. Of course, today we saw interest rates flat, stayed at 0.05, and probably not going to go lower. It seems like they consider that to be the lower point, the lowest point perhaps, and not going into negative territory as far as I've read. But they are going to do a kind of a quantitative easing program, as you can call it, like 60 billion, euros, $70 billion per month for the next 1.5 years for a 1.2 trillion total. So that's a fair amount of euros, and therefore the current euros becoming less valuable, and indeed euro-dollar falling some 2 cents so far in today's trading, or a bit more in fact, logically, because the euros are becoming less valuable. So I think that the technical picture and the fundamental picture that Annette and I have already discussed in various webinars in the last few weeks, through educational webinars here at Thursdays and Wednesdays, and live webinars and recaps, that indeed this is kind of like the confirmation that the euro-dollar is just heavily set in a downtrend and will continue like that. We will, of course, have our ups and downs, as always, but with this, I think there's little doubt that the euro-dollar should hit 110, and I even think parity. Maybe there's still some skeptics that don't think it will go that low this year. It's definitely possible, but in my vision, I think that's a pretty high probability. I already thought it beforehand. If you looked at the forecast webinar at the end of December, as far as I remember, I was talking about parity, and at that time we were about 120, I think, maybe 122. So anyhow, I think that is definitely on track. So it's big. It's a big news. It's interesting, of course. I think that let's see how much effective it will be for the Eurozone. I hope it will bring some real life answers to the economy, obviously. Let's see if that is so. As politicians have been also saying, basically, is that, and then Draghi himself too, is that this is a good step, but of course we need follow through from governments as well, not only from the ECB. So, well, that's the latest, I guess. All I can give my opinion on is the fact that it doesn't surprise me. I was expecting it, especially the last few days. Maybe last week I would have said 50-50, and I'm not surprised that the fundamental technical picture is looking still very bearish. So that's all I really have to say on it, to be honest. So the momentum, we had a lot of momentum to the downside on the euro-dollar. So trading with that momentum is great because you get a fast movement. I think that momentum, if you look at the euro-dollar chart, any chart, 5-minute, 50-minute chart, you just see a very good momentum. Even the hourly, in the meantime, you see 3 candles, 4 candles to the downside. That is a momentum. What is momentum? You might ask. Well, there's basically bigger size candles. They're candles that have closes near the extreme, either high or low. There are candles with less wicks on the tops or bottoms. So they're very decisive candles. They're not these corrective smaller candles. They're one-directional candles. So that is definitely the case in the euro-dollar at the moment. Very sizable push. And that is momentum, basically. It's fast, travels a lot of pips in a short period of time. Correction doesn't have a directional movement. It just bounces back and forth. You got a lot of mix of candles, and it just goes basically sideways and a lengthy period of time. Now, trading momentum is great because you get to your target quickly, right? So it has a lot of advantages. Oh, before I dive into that, basically you calculate it, right? Pips divided by time, and you get a certain, you can even calculate it. You can have a certain speed. If you have the patience for that, you can say, okay, this, for instance, now the euro dollar fell 240 pips or so in 4 hours, so it's like a 60 pip per hour fall. But and you can compare it to another fall where you say, okay, this traveled 100 pips in 6 hours, it's traveling 16 pips per hour. A lot slower, of course, than the one we just mentioned, which was 60. So the higher speeds, basically, the higher speed, the more likely we are able to move away from the average, the moving average. And the lower the speed, the less ability price has, the less power it has to kind of get away from the average. If price is bouncing back like forth like this, it can't escape the average that much. So you get this range with moving averages kind of flat in the middle most of the time. Maybe a little bit of a sway on the moving averages like this. Every time price tries to get away from the average, the moving average, then it doesn't get too far. So in this way, the moving averages, the average here is kind of a magnet. Is a magnet. It kind of keeps price to it, close to it. Right? It pulls price back to its zone, and you get maybe a bit of extension, but then it goes back again. It's like a gravity. Price sticks to that average. But if you get momentum, it has the force enough to move away from the averages, and then the averages start to bend. So in this regard, compare it, for instance, to a spaceship. If we send an airplane into air, it will have difficulties. I mean, it can get far, but it's going to be heading down to Earth because it's going to land. But a spaceship has enough power to move away from the gravity of Earth, right? So the more power we have, the more gravity we have to move away from those averages. We'll never totally escape it, otherwise price will collapse, but we have some power to move away from that. That's momentum. So we can trade momentum. It's very interesting to trade it. I think I have a slide about that, why, but in a second. But how to trade it, first of all, is you can trade it in various ways. You can trade prior to the momentum and try to position yourself before the momentum happens by taking a bounce trade. Let's say price is in the consolidation, so we look for a bounce trade off of the bottom here, and then try to position yourselves for the continuation. I position prior to the break, a candlestick pattern, for instance. The breakout itself could be connected to some kind of volatility, though. In some cases, this breakout, not unusual. Pullback after the breakout, continuation after the pullback after the breakout. We could look at further smaller breaks on lower time frames. For instance, we get consolidation and we have a breakout, pullback, continue. But along the way on the lower time frames, you'll have smaller consolidations along the way as you make momentum. You know, so you can take those smaller breaks as well. I know this is a lot of theory maybe, but and of course, if you do it too late, if you really enter too late in the momentum, which traders tend to do with momentum, unfortunately, then you're kind of chasing the market. Then you're kind of like buying it at the turning spot or selling it at the valley. That's when you kind of buy it too late. You're chasing the market in a way. It's, of course, not always clear that you are chasing the market at that point in time. I'm not saying, although there are methods to help your odds. But you want to be careful not to enter too late in general. So what happens? I guess I don't have a slide on the advantages of momentum, but momentum advantages, let me quickly summarize, is I mean, you just hit the target faster. So there's less insecurity, there's less nervousness. Psychologically, it's easier to stay in the trade most of the time. You don't have to live through a lot of consolidation, which means that you can use the capital that you risk again in a new trade, which means a higher turnover of trades. Usually speaking, if you are a positive edge, a higher turnover of trades is good because you trade more, which means you can have you can apply your edge quicker. So that's positive. There is also less chance of the trade losing because if you're in and out quicker there's a bit less insecurity about that trade. Staying in a trade and toughening it out through a lot of price action is sometimes needed. But if you can avoid, if you can avoid it, it is better because the conditions of the trade change the longer you stay in it. Let's say you had an initial condition for taking the trade at point A. There was, you have a certain circumstances to take a trade, right? You have A, B, C, D lined up, and that's why you took it. But if you wait long enough, the market changes, and 12 bars later, 24 bars later, those conditions that you took it are really not valid anymore. It's a whole different paradigm at that point. But you're still in the trade because of that. But all those reasons are not valid anymore. So that is a bit of a disadvantage. Of course, a trail stop or trade management could help with that. But so anyhow, market has moved a lot of distance. So market has already moved a lot. What do? We can trade still with the momentum, but there's a high chance of a correction at some point. Big stop losses, smaller targets left. Although maybe the chance of a loss is smaller, the R2Rs are not going to be that great. We could also do the opposite and try to fade the momentum. Not go with the momentum, but try to seek the turning spot and go against the momentum. Now, that has its definitely its disadvantages at occasions because catching a opposite of the momentum is sometimes difficult, right? It's actually very difficult because we often will try to, we Forex traders will try to do that too early. Not good. So the timing is important, but the timing is also difficult. And it's often going to be too early. If we try to take a long on the euro dollar by fading the momentum, that would not be so good at this moment, I think. Right? Maybe later on a bit for some correction. I think that's still too early in general. You want to be very, very cautious about fading them because normally speaking, the momentum pushes a lot further than we might expect. So it is difficult to catch it. The advantage is that there's a tight stop loss. We can go for bigger targets, but there's a higher chance of loss. Win percentage is low, reward to risk could be a lot better. Okay, so this is a typical bull flag. Momentum, bull flag, momentum. And if you see that, then of course a bull flag is a typical sign that your fading the momentum trade is not going to work in many cases. Now, sometimes a bull flag breaks down to the opposite side. But typically it's not a great signal to see because it's indicating consolidation and a correction, and there's a good chance of follow-through to the upside. So your fading the momentum trade is in danger. But if it makes a bounce after you're fading the trade or makes some momentum or even a reversal, obviously then that is something you would like to see, right? So chart patterns could help with identifying at what point you want to be careful with your fading the momentum reversal trade. And there's nothing wrong with if you have doubts whether your fading the momentum trade is indeed succeeding, there's nothing wrong with cutting your trade short there, even if you might skip a win. Because if you see signals, most of the time those signals are spot on if you see them. Most of the time, fading the momentum and you see signals that the momentum could continue, you're going to avoid a loss. So what kind of things could you use to help fading the momentum? That's basically the most important factors that make trading momentum more profitable and successful. First of all, before you even dive into price, let's talk about time factor. Many people, of course, only focus on price, and I understand that. But I do think that time factor has its usage, and I think it has an interesting aspect to add to a trader's vision. And if you look at it, I think it will help in getting an idea when fading momentum is a good idea. Time of day and week. If you look at the session times, taking a euro-dollar fading momentum trade just as New York opens, it's typically not a good idea. But if you see it a few hours later, when New York goes into lunch, that factor of time is already a big, huge plus. Same thing for taking a momentum, fading momentum trade on a Friday, or even on a Monday open. Because the Monday open, we can see kind of a retracement of last week before a trend continues. So those are definitely things that are interesting, especially the time of day, in my opinion. Time factor itself. Now, this is a bit of a tricky one, maybe for some of you, depending on how often you visited our webinars. I have mentioned it in the past, but time factor is interesting. When you have momentum, as I said, normally speaking, you see bigger candles, you see closes near the high or low, in this case high because they're going up. You have few wicks, mostly bigger size candles, few candles to the opposite side. But what you see mostly is higher highs and higher lows with these candles. That is momentum. But at one point, there are going to be a group of candles where the highs are not broken anymore like this. Right? Consolidation like that. So typically the momentum ends if 5 to 6 candles do not break the high, in this case, or in the downtrend, the low. When that does not happen, the momentum is usually over. So there's a sweet spot in terms of time factor, where when that happens, there's a decent chance that that particular direction of momentum is going to stop for a while. It could stop for another 7 candles, 8 candles, maybe even longer, maybe even up to another 20. But if it takes too long, if you get into the 14 plus candles, then, and it's still looking corrective, then it's probably more of a bull flag or correction. So between 6 and let's say 13, if it doesn't move in our way, then it's getting a bit dangerous. So between 0 and 6 is dangerous because the momentum is still perhaps going on. Between 6 and 13, it should go into a direction. If it takes longer than 13, then the correction could be actually indicating momentum continuation. Does that make sense? I'm talking really about the number of bars and candles in this case. I hope that makes sense. Divergence is, of course, something that's very good to see, especially double divergence on a 50-minute chart or 5-minute chart. We want to see the difference basically between price and the oscillator, which shows lack of momentum power. And of course, divergence, we can use volume indicators, we can use awesome oscillator, anything that shows a momentum and an interest in a pair besides the price. Candlestick patterns, of course, very interesting, especially 4-hour, 1 hour, especially 4-hour, I would say. Maybe 2 hours for some of you, but I like the 4-hour. Multiple time frames, obviously, if you have multiple time frame divergence, it is a bonus. Everything that favors or gives kind of extra support to a fading the momentum trade is a nice extra. In fact, if you don't have enough confluence, then probably the trade is not going to work out. You definitely want to see a multitude of confluences come together at that point, such as also support or resistance, a pretty sturdy support or resistance close by that can always help with turning or stopping the currency from moving into that direction. When you see kind of a confluence of those reasons, the probability of a turnaround are just increasing. That's how it goes. The more confluence, the higher the probability. Chart patterns is another confluence tool, and although requires a bit of experience to see. And the oscillators. Oscillators, anything on the bottom of your chart, basically. If it's volume or RSI or MACD or the awesome oscillator. So let's see. We have, for instance, here, let me take a look. It's a bit small. Your odd 1 hour chart. The trend is down. And we see a blue arrow, right? The price is moving up here. It's an impulse. It's a corrective impulse, probably. Corrective impulse. Down again. Wait, let me draw that with here. 1 second. Downtrend, right? This is a bit of an impulse, but corrective probably. A correction down to the 61.8 of the correction, and we see price go up to the minus 61.8 target. So it's like a zigzag correction. You see that? A 61.8 bounce up to the minus 618 target. A very neat golden ratio trade. Why golden ratio? Because the 61.8 is a golden ratio, right? So it's a perfect example. Not in real life, they're always not that perfect. Although I see plenty of them. It's not rare either. But I mean, sometimes you see the 50 fib obviously go to the minus 1,000 target. This is one of my favorite scenarios. 61.8 to minus 6.8. It's just, I like these particular ones, and they happen often, but not always, obviously. So when you're fading the momentum, after the zigzag is completed, it's a great way to fade the momentum. Why? Well, we got a lot of things stacked up in our advantage. We have a downtrend. We have the completion of a zigzag. We have a target. We have resistance here. We have, let's see, we don't have divergence, but we do have an oversold on the RSI. And that can happen sometimes. If you have a zigzag, sometimes that third move up is so powerful that it doesn't create divergence. So that is not something that is always a guarantee on a zigzag. If we have it, it's nice. It doesn't have to be. And if we see candlestick patterns, that's unfortunately not so visible in this slide, but probably we do, most likely. Then that is the final confirmation. That's how you can fade the momentum. The momentum here is up. No doubt about it, right? But do we want to go long, let's say right at this green circle, right in front of the minus 618 target, when the trend is down and we're close to that target, as I said, and even though the momentum is up? No. That's chasing the market. It's a perfect, the green spot is a perfect example of chasing the market. It's the perfect example of some traders getting emotional about missing the pips that they see they could have made and didn't. And yeah, that unfortunately happens occasionally. And hopefully not with you, but it's a horrible spot, as you can see. But yeah, there are traders that take that. And it depends on the time frame you look at, by the way, because that green dot on the lower time frame, by the way, could still be enough space to take the trade up to the target, I'm not saying. But on this time frame, there's not enough space. It would have to be on the lower time frame. Do you see what I mean? On this time frame, there's not. Because the stop loss is way, the risk is, in comparison to the reward, is of course a joke in a way, right? Because you're looking at something like this on this chart, on this 1 hour chart. Now that could be totally different on the lower time frame, because then it could look like this, right? It could look more imbalanced, excuse me. Okay, that's all I have prepared regarding the PowerPoint. Then I wanted to move to the charts and just look at some examples. While I do that, if you have some questions, let me know. That could be useful. I mean, is there something specific that you would are wondering? Any specific questions? Do you yourself sometimes try to trade this fading the momentum, or do you wait for more confirmation? Is there a particular pair you would like to see when looking at this fading momentum? Okay, euro-dollar. Well, I cannot say that this upside was really momentum. To me, it always looked corrective. I really cannot say that any of these trades are fading the momentum, because it's more like trying to trade the end of a correction to me, in my opinion, so I wouldn't consider that. But fading the momentum is, in my opinion, is a zigzag formation. Right? I guess, okay, just for, I don't know, for purpose sakes, example sakes, we can say that this is not so good example because this was right in front of the weekend. That's not so handy. Okay, let's say this example here. This is the euro-dollar downside. And you see a few candles going up giving an impulse like that, right? So we bounce off a lower fib, the 38.2 fib. You can hardly see it. And then get to the minus 618 target. It's a bit of a momentum here, like that. It's a small one, but still. So if you see some candlestick patterns at the minus 618 target, it's a good short. Now let's take a look at time factor. 1, 2, wait 1 second. 1, 2, 3, 4, 5, 6 candles. 6 candles that didn't break the high. So in that regard, we know that time factor is out of the way. This momentum is finished. And we could take a short there. Or I would take a short there. Right? It's at the target. If I'm not taking the target itself. Also, we have some bearish candles here. Those could be already reasons to take it. Personally, I would put my stop loss above here, though, and not above here. Because sometimes you do get one more push up and then the downside. You get kind of an extended correction like this. So then you see price giving 6 candles, not breaking it, and then indeed, boom, cracking down. The first breakout below the 21 band is this one, right? That would be another moment that I could enter instead of the 6th candle, which will be here, 2 different moments. Then we get a bear flag, the break of the bear flag, another moment to enter potentially. There's a potential scale-ins, if you like scaling in at least. This was maybe perhaps a bit of momentum, right? So what do we see? Fall, correction, target, minus 272 target. Sometimes you get a pretty good bounce there, up again, and then a fall to the minus 1,000 target. So that's something. That's why candlesticks are so useful, because sometimes we pass by the minus 618 like we did here. All right, but we do get. Let's see. We have, if we would take these engulfing twins, we might end up with a loss. Let me take a look. The low of this candle is 72. The low of this candle is 70. I would not take a loss on that, because I always go at least 5, if not all the way down to 15 pips below a low. So 2 pips would not take me out here. This second engulfing twins broke the red one broke the blue low by 2 pips. If you really go 1 pip below the low, you would lose. I don't do that, so I wouldn't lose. If you wait for this engulfing twin, then that's good. If you wait for the 6 candle rule, then it's 1, 2, 3, 4, 5. 1 second. 1, 2, 3, 4, 5, 6 candle. And you take it somewhere in here. And if you wait for the breakout, you would take it here, right? Why? Because we're in an uptrend at this point. I mean, if you look at it from an hourly perspective, it could be a correction on a higher time frame, by the way. But here, the moving average is already bullish, right? So this is a correction down, and we get the upside indeed. So this is momentum, and we're fading the momentum. But as you can see, we're fading the momentum, in this case, with the trend. And those are always, of course, in my opinion, a bit, those are the best. Fading the momentum with the trend. So you have a trend, and you have momentum against the trend, and then you're looking for the bounce back up with an uptrend. Or the opposite, of course, if you're in a downtrend, and you have a correction, a zigzag correction, you're looking for fading it back down. You could, of course, in a downtrend, look for fading the momentum back up. But then, I think, in my experience, the odds are less in your favor because of the fact that you have down momentum and downtrend, and that's a bit of a difficult combination. But there are points, of course, that it does work out. Let's take a look at here, for instance. But that's more, I mean, in my opinion, that's a reversal trade. This is a reversal trade. You got momentum here. Taking any trade here is a reversal trade. Not really fading the momentum, in my vocabulary at least, if that matters at all. But If we wait for the 6 candle rule here, it could be too late again with reversal trades sometimes. We'll be around here at the moment. Still, there is space though. You can use the moving averages as well to indicate that. In some cases, you can see trades going back to moving average or above the moving average. Here's an example of price momentum and or trend maybe perhaps, and a corrective zigzag. And this is why I don't like using the stop loss above the minus 618 target, because although the minus 618 target gets respected here, you see that you get a zigzag, an impulse, correction to the 50 fib, up to the minus 618 target, but you get one more leg up to the minus 1000. You see that? That's why I like using the higher stop loss in this case, because taking it, let's say after 6 candles, you take it here and you put the tight stop loss, boom, you just lost. But if you use a short here and you take the looser stop loss, you can survive this. And then you get still the turnaround, although it takes some time. So that's my side of the story. I'm going to hand over the presentation now to Nene. 1 second. Let me pass over the screen. There we go.
Thank you, Chris. Excellent presentation for momentum. And yeah, I definitely agree with you. The best is always to fade the momentum within the trend, because when we guys see trending patterns, then we usually want to align momentum with the price. I will explain that, and of course I will use my MACD 2-line indicator for that. But also it's good to know that momentum can be also faded as counter trend. So you can fade the momentum in the trend and counter the trend. Momentum is the only truth in the market. It speaks the truth of the current price action. So if you see, let's say that we can use today's example for euro-dollar, you can see that euro-dollar has been falling down a lot. So everyone knew, and everyone knows that basically that is a complete downward momentum. That means that the momentum is pretty much high to the downside and it's falling down. So momentum is to the downside. Once the correction starts itself, we say it's a retracement. What is a retracement? Retracement is a loss of momentum. So that is very good stuff to use when trading, because when you see and when you experience a loss of momentum, that is when you are ready to basically trade within the trend, to place an entry. For that occasion, MACD indicator is pretty much useful. Price itself also depicts the momentum perfectly, because the price itself is the ultimate momentum indicator. But we cannot just say that the price will give us the clearest possible picture for the momentum, because I will use the chart later. You will see today it was definitely very hard to long euro-dollar, because momentum was pretty much too strong. And if we had tried to, let's say, pick the entries randomly just by looking the price, which was reaching important supports, we would have been in a big loss. So fading the momentum is good. It works the best, as Chris said, in the trading environment. But if you want to go with counter trend, then you need to use a little bit different thing. Claudio is saying the presentation window is not loading. Probably. Do you see, guys? I don't know why you don't see it. I have shared my screen. Do you see it now? It's the slide momentum in Forex market. Yeah. Okay. Great. I don't know what happened, but this is basically what I'm seeing here too. So the truth, price and momentum. Momentum is equal to force. Don't worry, guys, about the slides. We always solve if there is any problems. So momentum is equals to force. I will tell you one simple thing today, and that will probably save you from losing a lot when you go counter trend trades. I will show you how you can use MACD indicator to spot the momentum for you and to basically keep you out of bad trades if you use MACD as momentum indicator. Because MACD, yeah, not all MACD. MACD 2-line is primarily trend spotting and momentum indicator. Momentum is also velocity of the market. Velocity of the market is also measured by momentum, because if momentum is strong, the market will definitely go faster in that direction. Momentum depicts also a battle between bulls and bears. If we see a lot of battle between bulls and bears, we can definitely know that momentum is inclined to be of the both ways. So that is also when MACD 2-line indicator can help us a lot. We also need to know about support and resistance levels, because as Chris said, fading the momentum usually comes pretty much good when we want to sell after the retracement, but very close to resistance, or to buy, let's say, of the very good support on a retracement. That is the time when we need to spot a momentum loss for that case, because we cannot just grab trade when price is falling free. We need to see the retracement, because always in retracement we get the better price. It's always best to buy after the price has jumped, has fallen down, and it's always best to sell when price has jumped. We say rally. So you will always get a better price if you're a little bit patient. Now there is only one thing which we could say about the momentum. There are some breakout trades which really exploit that fast momentum. Today we saw a pretty much bullish price action on cable, and that was the time when cable was going and breaking it was 1.5200, right? It was going up, and it finally break through 52. It came to 52.10, in a very big momentum, and then it dropped down, and it was around 51.90 by the time ECB announcement was due to happen. And what happened, basically, intraday momentum from GBP, which was bullish, it dropped. You could have scalped also, it doesn't matter. You could have scalped some bullish trades meanwhile, but if you made a position trade, basically you saw a big reversal today. It dropped below 50.50, which is very important support level. Now, what does it say? It says that momentum is a changing factor. It's not a constant. It changes a lot in Forex market. But there are some indicators which can help us to determine whether the momentum has changed or it's a simple trend retracement. And the worst thing is, if you want to scalp but you don't know where to put your entry, because you're just trying to guess those levels. It doesn't work that way. Yesterday we saw a huge drop in Aussie, and I will open my chart and I will show you. This is euro dollar, but let's open Australian dollar and look at this. Yesterday at this point, pay attention to MACD. At this point it was pretty much bullish, right? Because you have a trend line here, and you have also a trend line here. So we can say that this is bullish price action. Now pay attention to the indicator, and then I will explain you also about MACD. MACD, both two lines are above zero line, and the price is above this trend line. Now at this point, this was pretty much bullish price action. And even though if we go to 4-hour time frame, yesterday, look at this. It looked like it could be V-shaped reversal, which could have shape shift into cup and handle. But then Canada news kicked in. It was basically about rate cut, and Australian dollar is tied pretty much to copper, and oil price being a commodity currency, and that rate cut has had negative implications on Aussie. Until then, Australian dollar was bullish on intraday time frames. We cannot say it was bearish because it's very clear that it was bullish. And then what happened, at this point retracement has started. Look at this. But the trend was still to the upside. Why? Because you can see from MACD indicator, both of lines were above zero line, but red line was above blue line. So that means that it was basically a retracement in uptrend. At this point, the retracement was gone, and bang, the price went again to the upside. Okay? So that was pretty much strong implication of price momentum. And at this point, the price momentum was pretty much inclined to the upside, and then bang, it went down. And look at this, euro dollar is falling down pretty much to the downside. And as I said, 1375 was a definite magnet level. If you remember my interview with Dale Pinkert, and all these days I was saying that euro dollar was definitely attracted to 1375. And now it's happening, but we got none of retracement basically to have a good position trade, even though 20.00 was not closed, and that is what I don't like to see, free fall. I always like to see retracement. I always prefer to see that, how we call it, a loss of momentum, because loss of momentum is indeed a retracement, and that's always the best trade. Always the best trades can be taken with retracements. So let's get back to the slide. We can use momentum indicators for following methods: overbought, oversold conditions, chart pattern momentum breakouts, trend following, divergence. Whichever we use to choose of these momentum indicators can help us. Which are momentum indicators? Definitely two typical indicators are RSI and MACD. RSI is used usually for overbought and oversold conditions, so it will show us that momentum has already gone too high or too low, and that we might see a retracement. But MACD is used for detecting the trend and showing that retracement is underway. It's called a loss of momentum. So guys, remember, correction is equal to retracement, and it equals to loss of momentum in the trend. It's not the same as reversal. We will see what reversal is. The reversal is trend change. Okay? So most of the time I use a MACD. I'm not saying that RSI is not good. It works also, but it's more for showing you overbought and oversold levels. So we use MACD, which is the best indicator, in my opinion, for spotting pure momentum and loss of momentum. Now, how to measure momentum? Again, by MACD. MACD on charts give us valuable information about momentum and retracement. I use two-line MACD, which is modern MACD. Okay? So this is how it goes with momentum, and then we will see difference between the reversal, and I will show you euro-dollar chart. If blue line is above red line, and both of those lines are above zero line on MACD, we say that price has a buy momentum. Okay? So we need to have blue and red line on MACD two-line indicator above zero line, and in that case we say that the price has a buy momentum. Okay? If blue line is below red line and both are below zero water line, we say we have a sell momentum. Okay? So we have now a buy momentum and we have a sell momentum. Both of those lines are telling us the truth. This is uptrend, this is downtrend. Uptrend, buy momentum, and uptrend, strong buy momentum. It's indicated by these histograms. These histograms on MACD are telling you the difference between red and blue lines. So the length of this histogram equals the length here. The length of this histogram here equals the length here. the more the histograms are converging, you see, are going, losing the steam, the more the momentum is lost. So this is good momentum and good trend, but now there is a slightly fading the momentum. And in this case, if red line stays above blue or switches the position, so the red line is this and blue line is this, then we will basically have a loss of momentum in uptrend. This is a loss of momentum in uptrend. Okay? So pay attention to these things, guys. If blue line is below red line and both are above zero line on MACD, we say that the price has lost its buy momentum, and that is, it is retracing. It's still in uptrend, but it's a sort of retracement. Okay, blue line, red line, both of those are above zero line, but red line is above blue, so the price has lost its momentum. This was both trend and momentum. This is loss of momentum in uptrend. If blue line is above red line and both are below zero line, we say that the price has lost its sell momentum, and that is retracing. So this is when we have a downtrend, but the price is retracing. Okay, it's still in a retracement. So once retracement starts, we just do not know if it's reversal. We might say that it might be a retracement, a pure retracement, but we are not sure if it's a reversal or not. So we are not yet ready to say, well, it's a complete reversal. We don't know that. We only know that the price has lost its momentum and that it is reversing. But we are not sure if it's a complete reversal, so the downtrend or uptrend is about to change. All reversal starts from trend. So all reversal trades start from trend. So they go in this pattern. We have a trend, okay? We have a trend. We have retracement. These are retracements. And at some point, we have a reversal. This can happen on every single time frame. It doesn't matter if you use 5 minute, 1 minute, or 1 month time frame. Every time frame has a trend. And every single time frame has a reversal. So that is why it's important to distinguish between trend and reversal, and retracement and reversal, because you just cannot know whether there is a start of a trend or start of possible reversal which will switch the trend. You just cannot know that. Okay? This is a huge uptrend on euro yen, and we can spot it on 1 hour chart. You can see it here, 1 hour chart, and definitely a nice uptrend. Okay, then what happened, and what at one point the price has lost its momentum. It was drawn very close to this level and it couldn't jump off of this level. We draw a trend line. We see that the price has broken through this steep trend line, through this, I can say, neckline, because this is left shoulder, this is head, this is right shoulder, or this is double right shoulder. And what happened is bang, breakout, retest, continuation. So this was the moment when trend was about to change. At this moment, there was still enough momentum to push the price to the upside. And it's okay. You still can make pips, and you still could have made pips out of this point. But the main problem stays when the price is not giving us any chance to go up, and it starts basically to have a free fall. Now that is when momentum is about to change, and that is the point when we can say the reversal has started. Okay? It's not good, guys, to pick levels by yourself. Okay? It's definitely not good to pick levels by yourself. It's always best to wait for divergence and wicks. Okay? It's the first sign towards loss of momentum. Retracement is the first sign. And divergence is the first sign. because when divergence appears, somehow you know that you can basically count on possible momentum shift and the price will go in your favor. After the divergence can be confirmed, you can enter. So Chris was talking and telling you about trend retracements. And it's actually good. You have a trend, you see a retracement defined by MACD, you draw Fibonacci level, you see that it's still uptrend, bang, you can enter. Okay? But what happens when we are not trading the momentum in trend? It's called fading into strength or fading into weakness. I will show you a system which you can use to fade into strength or weakness in one of our next webinars, but at this moment it's important for you to see momentum and to define it. Let's switch to euro-dollar chart. Today we had a nice up momentum. So this was, today's price action. So you can see the price was, let's go on 1 hour chart. Because 15 minutes is used for scalping and 1 hour chart is used for intraday setups. So we will go with intraday. You can see at this point that Camarilla shows the price above L3. It means the price is bullish. As long as it is in between L3 and H3 and it's rejecting, as we can see from L3, it's trying to reach H3, it's a bullish price action. Bullish on intraday time frame. And how you can also see it's bullish? Well, basically you can place a trend line. And definitely you can see that the price has been bullish. So you have a trend line here. Okay. You have a rejection of these trend lines. The price is above L3, and look at MACD indicator. What does MACD, what is it saying to you guys? MACD indicator, what is it saying? It says we are still, because this is zero line, we are still above zero line, so we are still in uptrend. And that means that you still can go for retracements and find entries on the retracement. So this is retracement, and look at this. Bang, retracement. Retracement. 60 pip potential. Retracement. 70 pip potential. Because MACD is saying you can fade the momentum. This is momentum. This is retracement. But the price is still in uptrend. And you don't want to buy high. You want a retracement to buy lower. That is what Chris was explaining. It's called fading the momentum. So at this point, momentum start to shift. But we are still in uptrend, 1 hour time frame. It's still in uptrend on 1 hour time frame. Every dimension speaks for itself. Okay? Here, retracement, bang. Bang, it goes down. Okay? It's not so hard to define it, guys. You just need to watch the price action. And at this point, look, both this line went down. You had a great rejection from this level, but it was not. It was 60 pips. It's still enough to give you some buy trades, because you see the price was still bullish until this point. The price was still bullish here. Bang! It lost its momentum, but the price was still bullish there. And at this point, when there was a rejection, we can see that both of those lines basically were going down, 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 down. That means we can start now looking for short entries. Okay? And now if you go and boil down to lower time frame, of course, 15 minutes, whatever, you can see that now there is a trend on 1 hour chart, so you can find entries on 15-minute time frame. So this is very useful. MACD is always good to have on your charts, because it's pretty much very useful for defining momentum and defining trend strength or trend weakness. Okay? So I suggest you should have it. We can also see that on Aussie, Australian dollar, 1 hour. Look, momentum, loss of momentum, but look at this. Both of those lines went down. So we don't have any particular retracement on 1 hour chart. If we drop to 15-minute time frame, we can see this. This is okay, and it gave us, and this is the even better example. It's still uptrend at this point, but this is retracement. Align MACD with Fibonacci. Okay. At this point, both of those lines were above zero line, and we had a retracement. This candle is very close to 78.6, so the entry around this zone, and look at this, 50 pips. So aligning the trend with momentum can always give you good results. Okay? Now, if you want to go for divergence trades, this is different than trend momentum. Divergence is the first sign of a probable reversal. In this example, on 15-minute time frame, I'm showing you regular bullish divergence. This is historical L5 Camarilla level. So at this point, or at this particular day, it was yesterday, this was L5 Camarilla level. The price has hit Camarilla level. It was divergence. You see many of those wicks, a lot of wicks, which indicate strong buying. And at this point, if your entry was at the cross of MACD, you could basically go counter trend. And this was the good example how retracement can become a reversal. Now we are talking strictly from 15-minute time perspective. On 15-minute time frame, we had a downtrend. This is huge downtrend. Then regular bullish divergence. This is divergence, and you go here, this is loss of momentum. Okay, because the price is still below zero line, but blue line, it goes above red line. Loss of momentum turned into reversal at this point on 15-minute time frame. So guys, this is everything I wanted to show you. You can use MACD2 line to your advantage, of course. This is useful information for spotting retracements and trends. If you have any question, you can ask me. If not, guys, do not forget to sign up for all of our good webinars coming in soon. Weekly Forex recap on Monday, 5 different setups, and hopefully many pips as we had this week. Then live trading lab with Chris, and do not forget to sign up. I don't see any questions, so I can assume everything is clear. Thank you guys for listening to us, and we will be with you very soon. Cheers and trade safe.